Are we in danger of experiencing poverty in a severe recession because of an economic collapse? Will a super-inflationary melt-up be prevented by the Federal Reserve's Jerome Powell? What is my strategy in investing in stocks during this confirmed downtrend, which could result in a crash? Hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everybody, the market was in a confirmed downtrend for most of the year and certainly most of this week. But on Friday, we got a good unemployment percentage number. The unemployment percentage moved up to 3.7%. The Federal Reserve at this point likes to see it move up because they're trying to destroy jobs, as horrible as that sounds, to put a cap on inflation, because the main threat is inflation, and we're in danger of a super inflationary melt up. Okay, the stock market does not impress Powell as being in danger of a crash. He thinks it's in danger of a melt up due to inflation. And that's where the stock market takes off, the dollar weakens, and inflation chases the stock market. It tries to chase the stock market down, which is probably what's going to happen with the Federal Reserve. They will try to chase inflation down. The unemployment number for the previous month was 3.5%, so going up to 3.7% was good news to the Fed. This is weird. I hate these phases where bad news is good news, but that's what we have. And that's why it's hard to read the market sometimes, but you literally have to try to decipher how the Fed is thinking about things, because the Fed rules all at this point. I no longer think that the main danger is recession. In the third quarter, the GDP went up 2.6%. So it was positive, and that kind of undoes the recession fears to some degree. But recently, the Atlanta Federal Reserve predicted that the GDP for the fourth quarter would be 3.6%. So it's an improving GDP. And this is what I've come to realize, is that now we're not in danger of recession. We're in danger of a super inflationary cycle that wipes us out unless you have some assets. The stock market can go up in these cases, but it's going to have difficulty because the Federal Reserve is going to be like a jockey on a horse of the economy, and they're going to try to hold that economy, try to hold that horse back. That horse is too spirited. It wants to run, and the Federal Reserve is going to do everything it can to hold on and hold it back. Until recently, the Federal Reserve's interest rate hikes have had about as much effect as shooting a ping pong ball against a tank. They haven't had much effect at all. But there's some beginning indication that maybe the last interest rate is starting to have an effect, and we won't see the effect of the most recent 0.75 increase, which increases it to 4%. We won't see that until next month, okay? But we're beginning to see the increase to 3.25 is having some effect. Open Doors, which is a realty company, they have cut their staff by 18%. So you're starting to get the unemployment. Lyft has decreased their hiring and their staff by 14%. And Twitter Uh, Twitter's sort of a special case because Musk wants to rejuvenate the company, wants to replace people in the company. So these are layoffs, but they will be replaced probably by new people unless Musk can figure out a super efficient way to run it. But Twitter recently announced that they're laying off 50% of their workforce. And Apple is saying that they're doing no new hiring except for research and development, which they need to do to keep technology coming. So we're beginning to see some effect. We have major events coming up next week. Next week is the week of the midterm elections, and the market traditionally goes up during and after the midterm elections. So we will see whether this year follows that form or if this year is somehow an exception. And on Thursday, November 10th, we get the CPI report, and that will easily be more eventful, I think, for the stock market. And I think it's probably going to be up, which is bad news, and which will further validate the Federal Reserve to keep increasing the interest rates. But it's expected to be up, in my view. It's simply because the price of gas was up, and so it's likely to be up. I have steel stocks that I've followed for years, and I like steel as a good, steady investment. And I think I'm more conservative in this phase of the bear market. You know, the VIX has come down. The VIX is a measure of volatility, and volatility is usually higher in bear markets. And if you have a VIX over 25, 25 is the dividing line in my mind. If it's 25 or over, you have a very volatile market, which is probably a bear market. And I probably will be doing leveraged funds on a day trading sort of basis. If it's between 20 and 25, that's indeterminate. And the more that it tends towards 20, the more it tends to go towards bullishness. Below 20, you're usually in a bull market, and I don't hesitate to invest at that point. This steel stock that I love is Steel Dynamics, and its symbol is STLD, and it's been a good performer. And it also is environmental in a sense because they do a lot of recycled steel. So you're participating in a basic industrial stock that has good effects on the ecology of the country. So Steel Dynamics, STLD, that's the 1-year chart you see there. And it moves around, let's put it that way. But conditions seem appropriate for it now as materials are going up. Steel Dynamics trailing price to earnings is 4, and its forward price to earnings is 8, which indicates that you're getting a lot of bang for the buck. It's a good buy, and also that their earnings are increasing. So that's good. The earnings growth rate is 26%, which is excellent. Steel Dynamics price is about 95. Its value is around 112. I would like to buy it below 90, and I would sell it if it went below 85. Energy is easily the strongest sector, and it's at around 92 now. It's projected probably to go to about 105. And there's world events that affect this. There's so many things that affect oil prices, but it seems like Europe is going to have a pretty cold winter, and supplies are going to be short for at least a while here. So it's probably safe to trade for now, and it is the strongest sector. And between energy and materials, those are the main sectors that I see worth trading. Oil you can trade in 3 different ways. You can go with the major oil companies. You can go with one of the hundreds of less capitalized companies, or you can do an ETF. Why don't I give you some choices of each of those? When I invest in a sector, I usually like to start with going to the top of the heap and picking up one of the usual suspects. And what more usual suspect could there be than ExxonMobil? And boy, their profits are almost obscene. The symbol for ExxonMobil is XOM. And this is the strongest oil company, I think. And I think you could hold it as a long-term investment if you could stand the gyrations. But usually you're ahead with oil companies to play the gyrations, because gyrations they will be. So in my mind, oil stocks are trading stocks. But in this bear market and the outlook and whether Powell is going to be successful in chasing down inflation, I want to be trading stocks. I don't want to hold on to them until they go down because demand has been destroyed. ExxonMobil, good old XOM. Its price is about 112. Its value is about 144. Wow. Its forward price to earnings is about 11. Its trailing price to earnings is about 9. So poor ExxonMobil is so undervalued. Their earnings growth rate is 40%. You know, that's like Tesla's growth rate. And this is an old established company, so it's pretty outrageous. As you can see from the chart, they've had a nice upward movement this year. And again, as long as demand doesn't get destroyed, we're going to have a solid investment in ExxonMobil. It's not too much of a risk, I don't think, unless something surprisingly happens. As oil problems and the supply problems, and I think demand will fluctuate and will come off and on. So oil is always going to move around, but it's definitely been up, and it's been up to 120 within the last year and a half. So it's not much of a stretch to say it's going to 105. I think it's a pretty sound investment, of course. And ExxonMobil also pays a sizable dividend of 3.24%, which is a good dividend nowadays. I wanted to give you an example of a smaller oil companies to give you some different kinds of ways of approaching this oil business. And I decided on Liberty Oilfield, whose numbers are almost as impressive as ExxonMobil. Liberty Oilfield's symbol is LBRT. This is the 1-year chart on LBRT. Its price is around 17. Its trailing price to earnings is also 17, but don't let that worry you, because its forward price to earnings is around 6. And when you have a dramatic drop in price to earnings like that, it's because they're earning all kinds of money in the present, okay? And their earnings growth rate is 39%, which is only 1% less than ExxonMobil, whose profits are obscene. So this company is doing very well. And I think it would make a good short-term investment in my mind. I probably still would favor ExxonMobil. Just, you know, it's much more of a conservative, sure bet in my mind. Let's talk about ETFs that you could possibly buy. One is XLE, which is a bullish fund on the energy sector. And then there's a double leverage bullish fund on oil. and that is GUSH, G-U-S-H. It's an oil gusher, okay? And then there's NRGU, which is a triple leverage bullish fund on 10 very large oil companies. So for every dollar that index of 10 very large oil companies goes up, you make $3. Okay, you can also lose a lot of money because if it goes down 30%, you've lost 90%. So you got to be careful with these. Looking at this chart of how the different oil ETFs have performed, XLE in purple has made 66% since the beginning of the year. You would think that would be good enough, but GUSH, which is a double leverage oil fund, has made 122%. And NRGU, which is in light blue, it made 274% since the beginning of this year. You have to decide what your risk level is. Right now, my risk level probably is with XLE, although I can probably be talked into the others because I love leveraged funds. So I don't think we're going to go into a severe recession. I think what we're living through is an inflationary nightmare. And I think Jerome Powell has been trying to say this to us over and over. He's not worried about a recession. In some sense, he might be relieved with a mild recession simply because that would solve the inflation problem. He's much more worried about superinflation occurring where we pay just ridiculous prices for things and which has to be stopped. The reason he doesn't emphasize it even more is because I think he's worried about raising inflation expectations. And if he raises inflation expectations, those expectations will lead to people buying things early to avoid the cost of it later on. And so you will get even more inflation. And so that's why I think he hasn't spelled out the inflationary nightmare as much as he could have, or maybe even should have. That's the way I roll. I think we're avoiding the inflationary nightmare. The way to play it is oil and materials. That's what I'm doing. That's what I'm looking into. Be sure to like and subscribe. Hit that notification bell if you want to be notified of future videos. And thank you very much.